All right, guys, let's get into chapter 10. So, the difference between bond financing and kind of stock financing or loan financing, it really kind of mirrors loan financing more than it does stock. So, what we're going to do is we're going to have a way of setting this up. It doesn't have any control, okay, over a company, but it does kind of represent a way to have some more capital into your company. Um, what we're going to have is we're going to have a stated face value of the bond, and it's going to have a interest schedule that we're going to have to follow. It could be either annual or semi-annual, and we could be able to pay these out. And we do not reduce the principal of the bond until we actually retire the bond at the termination date of the bond. All right, all right. When you see this, either on our homework or on an exam, it could actually say it's being sold at 103.08% of the face value, or it could say it's trading at 103.08. They are the same thing. All right, so don't let that confuse you. All right, par value. If we issue our bonds at par value, we're going to treat this like we've done any other note payable. It's a bond payable. We will debit the cash that's going into our bank account, and we set up our liability. All right. We have all this other information here, the stated interest rate, which is the face value interest rate. That's the interest we're going to pay off of the par value. We have the interest payment amounts, interest payment dates. We have to pay them on June the 30th and 12/31, each of those intermittent years. And then at 12/31 of December 23, we will pay the bond money back to the bondholder. All right, so they are semi-annual interest payments. So just like we've done before, if it's an annual interest amount of 8%, we'll give them 4% at each of those semi-annual payments. All right. And then when we retire the bonds, when we pay them back, we'll give them all of their money back. Face value is not a problem. All right. So here's the difference. It takes a while to get this through our board of directors, and we may not issue all of our bonds either. All right. This actually helps us when we might trade these bonds after the original issuance as well. All right. We might be holding company bonds for other companies as well. So if the interest rate changes over time, then the bonds we're holding, either we have it issued or on another company, whatever, we're not going to get face value if the stated rate, the face rate, is not equal to the market rate. Okay. So if the rate in the market, if I have $100,000 to invest and you have a bond for your company that you're willing to give me 6% for my money if I invest with you, but I can put it in another investment for 8% return, why would I give you $100,000 to do that? The answer is I wouldn't. So to sweeten the deal, you say, well, give me $90,000 now. I will pay you 6% interest off of the $100,000 face value of the bond. You don't change the calculation. And then when I retire the bond, I will pay you back an additional $10,000. I'm going to pay you $100,000 for the face. So I'm buying a $100,000 bond for $90,000. That's what a discount is. Premium is just the reverse. Okay. So you can see here our example. All right. The issuing price is 96.4%. So I'm going to get $96,400 for this bond. As the issuing company, that difference, okay, this $3,600 difference is an additional interest expense to me. It is what I'm using to true up the difference in the interest rates. So I have to account for that when I make these payments. All right. I said all the way through 241. I'm going to continue to say it now. Start with what you know. Okay. I know I got 96.4 in cash, and I know I have to pay back the bond payable of the full amount. That does not change whether I have the face value or the par value or a premium or a discount. Does not change. This difference here is my discount. Whatever I have to make it, the discount is only going to be on our debit side, and our premium is going to be on the credit side. All right. This does not, none of this stuff changes, okay, for the bond payable. This is always going to be paid back at the face par value. All right. So I said this earlier is that I know I'm still paying the interest off of the full par value of the bond. I'm still going to give them 8% of the $100,000. But I've got to get rid of this. It's just kind of like accumulated depreciation. I have to get rid of this bond discount over the life of the payments. So I have to take this $3,600 and get rid of this four times to where when this is zero too. I don't want to have any discount on this bond left when the bond is gone. So I have to amortize this discount when I'm making these interest payments. So this is my true interest expense that I would show in my books, even though I'm only giving them $4,000 in cash. All right. The premium works just in the opposite. All right. I know I got more cash than the face value of my bonds, of the par value of my bonds. The premium is our difference. All right. So we're going to amortize this premium the exact same way. It's going to reduce my interest expense because I got more money than the face value and the par value of my bond. When I retire the bonds, when I give them their money back at the expiration date of the bonds, this entry is the same for all three examples. For face, for par value, for a discount, and a premium. We're still giving them the $100,000 back. None of the other issues, whether it's a discount or a premium, none of that affects this cash payment. Okay. If we have the ability to retire bonds early, then we have to look and see what our carrying amount of the bond is, which means how much of our unamortized premium or our discount is left, and decide, am I having a gain or a loss by essentially saving myself interest, or am I paying too much, just like I would on gain or loss of an asset? Okay. All right. Long term notes, same way we've done this before. So this way, we're actually going to figure out how much of our payment is reducing the note and how much is going to interest. All right. We don't have to calculate, thankfully, this payment in this class. Eventually, you'll have to go through and figure out this table to figure out if it's a monthly payment, semi-annual, or annual payment. So in this example, they give us our payment amount. We have a payment that's a $60,000 loan, 3 annual payments at 8% interest. That's information we need on the next table. All right. So we do this kind of like, it's kind of like double declining balance. But what we're going to do is we're going to say, one, the payments never change. For those that have had a car payment, you know that your car payment is identical. It's the same every single month. Nothing changes. All right. So what we're going to do is we're going to have our interest amount. Interest is calculated by how much money you owe the bank. So it's 8% interest for this year times our outstanding principal amount, which is the $60,000. So that's $4,800. So of our payment, that's the same, the $23,282, $4,800 of it was interest. Well, the difference has to be what goes to the bank to reduce the loan amount that we owe them. All right. So that will reduce how much we owe them, which becomes our beginning payoff balance at the beginning of the next year. So at the end of the next year, we owe them 41,518. We will calculate the interest expense on the next payment the exact same way. So at the end of the third payment, we should owe them nothing. All right. So we look at our payments for each year. The cash outlay is the same, but the composition, the breakdown of each payment is all that changes. But the cash payment should be identical. All right. Mortgage I talked about before is what our legal agreement is. We're going to file in public record to let everybody know that yes, we've borrowed money. And the bank is going to kind of their placeholder to let everybody know that there's something out there that you need to check before you can sell this property. All right. Let's get on through this right here. Not really that big a deal. All right.